Most investors just react after things happen, like chasing the red laser. Smart investors prepare before the market moves. So Lumen, tell me, what really happens when a bubble bursts?
It's not simple. Stocks won't just fall. The next phase is more complex, and it hits close to home.
So when the bubble bursts, stocks fall, and that's it?
No, they don't just fall. They get dumped. Hard. Leveraged funds face massive losses and margin calls. To survive, they sell everything: stocks, bonds, ETFs.
Even the companies that make my favorite gourmet cat food?
Especially those. Panic doesn't discriminate. During the dot-com crash or Lehman, S&P 500 and Nasdaq dropped 15 to 20% in weeks. Not because the economy collapsed, but because someone got a margin call.
So the Fed swoops in with a giant hose of money, right? Problem solved?
Imagine that firefighter also has to water a delicate garden. But the water contains gasoline, so each splash could ignite another fire. Core CPI is already near 3%. Too much money risks flooding the economy. One hand sprays, one hand pinches the hose. Inefficient, but necessary.
So monetary injections is not equal to instant stock recovery?
Correct. Banks hoard capital. Funds flee to safety. Even with liquidity, confidence takes time to return.
If the government sends checks, people will invest, right?
Not always. With weak employment, most people pay rent, buy food, cover utilities, or repay loans. Money flows to Main Street, not Wall Street.
So we get asset deflation, but living inflation?
Exactly. Your assets shrink, while the cost of living rises.
But why does my cat food get pricier while stocks fall?
Simple: costs rise everywhere. Energy prices, supply chain disruptions, labor costs.
Even if we cut luxuries, essentials stay in demand?
Exactly. So the cost of living won't go down.
Where do smart investors find opportunity?
By separating price from value. Example: an electric utility, stock down 20%, but profits up 30% thanks to rising power prices.
So panic makes good companies look cheap?
Yes. Panic equals temporary bargain season. Focus on businesses that can raise prices even during inflation. And maybe a few cat food companies that can raise prices without losing customers like you.
Should we check multiple sectors? Utilities, gas, food?
Absolutely. Look for revenue models that withstand inflation. Identify the truly valuable assets. We're not just buying stocks, we're buying cash flow machines.
Then S&P 500 is safe, right?
Not necessarily. Megacap tech dominates the index. Even passive investing can miss inflation-resistant, essential companies.
So safe can be misleading. How does the market recover?
3 steps. Panic and undervaluation. Stocks fall below intrinsic value. Selective buying, target high-quality, essential businesses. Price correction. Stock prices catch up to profits.
How long does that take?
Months, sometimes years. My algorithms estimate longer than your average interest in a new cardboard box, but worth the wait.
So cash is king is a myth?
Cash isn't king, it's melting ice. During inflation, only truly valuable assets go on temporary sale.
So we need an eye for real value, not follow the crowd?
Correct. Invest in essential, inflation-resistant businesses with pricing power. Learn before the market moves. Prepare, don't just react. Panicking is for amateurs. Planning is for investors. And snacks are for cats after research is done.
I was thinking of stockpiling food, but I get hungry and eat it right away. So much for bulk buying.
That's not savings, that's a deterioration of short-term liquidity.
So my stomach is basically a black hole?
Your stomach appears to be operating as a high-frequency consumption algorithm-equipped high-eating fund.
Inflation hedging for food expenses is tough.
Countermeasures. 1. No grocery shopping while hungry. 2. Freeze in small portions. 3. Impose a snack inflation tax on your future self.
I can't believe I need monetary policy for my own stomach.
still more reliable than some central banks.